Hello everyone, this is Dr. Mihir Shah once again with another video. In this video, we are going to learn how to value the shares as per yield method, also known as the earning capacity method under the chapter risk management in project under the subject project management. Now, in this chapter, that is risk management in projects, there are two types of valuations of shares. One was net asset method and the second one is yield method. The topic related to net asset method, the video has already been created. This is the second part of the same chapter where we are going to learn how to value shares as per yield method or at times known as earning capacity method. Now again we are going to take up two sums in this to understand how you need to solve the sum based on yield method. But before solving the sum, we'll have to go through some formula, some format. So let us see that what it is. I would like everyone to note down those formats and those formulas. Okay. So we'll start with the format. Now formula first of all. Now valuation of share as per yield method, also known as the earning capacity method. The formula for value of share, that's the final formula, is expected rate of return upon normal rate of return into paid up value of the equity share. That's the main formula. ERR, that is expected rate of return, upon NRR, normal rate of return, into paid up value. Now, in order to find the expected rate of return, there is a separate formula for it. ERR, or expected rate of return, is equal to available profit to the equity shareholder upon equity share capital into 100. Okay, equity share capital will be directly given into the question. Available profit to the equity shareholder, we'll have to find that. Okay, so for finding the available profit, there's a format. To find the available profit, the formula is basically average profit before tax less tax will give you average profit after tax. Once you get average profit after tax, less all the transfers to GR if any available, or and less preference dividend again if anything is available. Okay. So whenever you transfer to GR or whenever you transfer to preference share, whatever amount is available, that is nothing but the available profit. Okay. Once you'll get that available profit, okay, you can apply into the ERR formula, that is available profit upon equity share capital into 100. You will get your ERR. Then ERR gets fixed in your numerator under the value of share formula. Mein. Normal rate of return will always be given in the question. So you just have to divide, multiply by the paid up value, and you will get your final value of shares. Now let us see how these three parts can be inculcated in a sum. Okay, we are going to take up two variations of sum, two completely different sum to each other, but under the same method, and we'll try to see how you can use the same steps to get the final answer. Okay, chalo, let us see solving it one by one. We'll start with the very first sum.
Okay, now this is the very first sum based on the valuation of shares as per yield method, also known as earning capacity method, depending on what they ask you in the question, but both means the same. Okay, now before solving the sum, okay, let us first read the question, what it is given all about. It is said that the following is the balance sheet of Arjun Limited as on 31st March. They are giving you various liabilities and assets. After that, they are giving you that the company transfers 20% of its profit after tax to general reserves. The net profit before taxation, the before tax PBT is given to us of the last 3 years have been given to us. Then it is mentioned that the average yield in the type of business is 20%. So they are giving you some normal rate of return, which is 20%. The rate of tax is 50%. The asking is to calculate the value of equity share as per the yield basis or yield method, also known as. Okay. Now remember that in order to find the value of shares per yield method, okay, we always need to start by finding the profits available to the equity shareholder. Once you get that, then we just have to apply a few formulas to get the answers. Okay, the very first thing what we'll make, we'll be making a statement whereby we'll be trying to find the value, the value available or profit available to the equity shareholder. Okay, so format will be very simple. Okay, we will have particulars and we will be having a simple column. So there's not basic format anything. We'll just note in our particulars rupees. Okay, step number one, we need to first find available profit to the equity shareholders. So for that, the basic format is very simple. We need to first note down the profit which they have given years. Okay, so now they have given us profit of 3 years. Okay, so we need to first find the average profit. So for what we'll do, note down here, they had given us various profits. Profit as on 31st March 2012, 31st March 2013 and 31st March 2014. The values are 5,44,000, 7,32,000 and 7,88,000. This is the profits that they are given us. We need to find number one, average profit. The average profit is nothing but the total of this profit divided by 3. Now the total of the profit is 20,64,000. So average profit is nothing but 20,64,000 divided by 3. So our average profit, once you divided by 3, we should get this answer as 6,88,000. So my average profit is 6,88,000. That is nothing but profit before tax. So now since this is profit before tax, our next step will be less tax. And in the question they're giving you tax at 50%. So we are going to find as 50%. That will be 3,44,000. You subtract, we will get profit after tax. After getting the profit after tax, we need to see if there is any transfer to reserves or any preference dividend given in the question. Now, preference dividend is not given in the question because you can see there's no preference share in the question. But then they are giving you an adjustment stating that you need to transfer 20%. So let's transfer to GR, general reserve, at the rate of 20% is given. So 3,44,000 ka 20% is 68,800. Okay, we subtract it and whatever amount you get, that will be nothing but 2,75,200. That is nothing but amount available to the equity shareholder. So this is nothing but, I'll write here, this is available profit or profit available to equity shareholder. This is the first part. Okay, once I get the profit available to the equity shareholder, the second step what we need to do is now need to find something called as ERR, expected rate of return. Now the formula for getting expected rate of return is the profit available. So we write it available profit to the equity shareholder, available profit upon equity share capital into 100. Now in our case the available profit is 2,75,200 upon the available equity share capital. Now if you look into the question, the value of equity share capital is 10 lakhs. So I'll write it here, into 100. When you divide, you multiply, you should get the answer as 27.52%. So our expected rate of return or ERR, also known as ERR, is 27.52%. Now last step, once you get the expected rate of return, the last step is you're finding the value of share as per yield method. The formula is very simple. ERR, that is expected rate of return, upon NRR, normal rate of return, into the paid up value of equity share. Okay, so now our ERR we already found that as 27.52. NRR, normal rate, is already given in the question as the normal yield, which is 20%. So we take that as 20 into paid up value. Now in the question equity share is given, the paid up value of each share is given as the share is 20 rupees each. So into 20, remember no percentage, okay, we just have to take directly the value. So 27.52 upon 20 into 20, the final answer what you get is nothing but your value of share, which will supposed to be 27 point, because 2020 gets cut down, so 27.52 rupees is the paid up value or a value of share as per yield method. Okay, so this is how you all need to solve the sum when they ask you to find the value of share as per yield method or earning capacity method. You need to first find the available profit, find the ERR. Once you get that, we apply into the main formula, ERR upon NRR into paid up value, and you will get your, the value of share as per yield method. Now, this was the very first sum. Now we're going to take up a second sum, a little variation, same stuff to do, but in a different way, a different variation in the question. Okay, so let us see how to solve that particular sum. Sum number 2. Okay, now let us see the second sum. Okay, now let us read the question. Now this is a different variation in the sum. From the following balance sheet of Ninad Limited, they are giving you liabilities. Under liabilities, they are given as preference shares. There are debentures and assets have been given to us. After that, they are giving you details of sale, expenses and interest for the last 5 years ended are given to us. We have sales and expenses, interest on loan, interest on debenture. Remember, interest on loan, interest on debenture and expenses, they all are expenses. Rate of income tax is given as 40%, NRR is 12%, fixed assets ka values have been given to us. And thereafter they told you find out the value of equity share as per earning capacity method or yield method. Now again, very simple. In order to solve sum based on yield method, we need to have, the step is you need to find first the available profit to the equity shareholder. For that we need average profit, or we need the profits. Now in the sum, they haven't given us any profit, but they have given you sales and all the expenses. We know that from sales, if you deduct all your expenses, whatever remains is nothing but your net profit. Once I get my net profit, we will find the average profit. From average profit, we will remove the tax. We will remove the preference dividend and any transfer if there are any. In the sum, there are no transfers, so we'll remove the preference dividend. Whatever amount is available is nothing but amount available to the equity shareholders. Okay, so based on that, let us see how we solve the sum. Now, they have given us, so I'll note down your particulars. They have given you data for 5 years. So we have 2011 ka data, 2012, 2013, 2014 and 2015. The very first thing that they are given you is sales. The value of sales are the value of sales are 4,50,000 for the first year, 5,50,000 for the second year, 7 lakhs for the third year, 4 lakhs for the fourth year, and 8 lakhs for the last year. From that, we have to less all our expenses. Now they are giving you expenses as 1,75,000. Okay, even we need to less interest on loan and less interest on debentures. So interest on loan for the first one is 10,000. Interest on debenture is 15,000. For the second year, it is expense of 2,90,000, 20,000 and 15,000. For the third one, it is 3 lakhs, 25,000 and 15,000. For the next, it is 1,55,000, 30,000 and 15,000. Last one ke liye it is 4 lakhs, 10,000 and 15,000. So from sales, when you subtract all your expenses, okay, whatever we'll get is nothing but our net profit or our profit before tax. So I'll write here profit before tax. So I'll write this as PBT. Okay, profit before tax. So the profit before tax should be, for the first case, it is 2,50,000. Next is 2,25,000. For the third one is 3,60,000. Fourth one is 2 lakhs. and 3,75,000. Okay, once you have got your profit before tax, now very simple. Now we need to find, now we go as per our format. As per our format, we need to find average profit. Okay, now average profit before tax is nothing but the addition of all the profit before tax. So 250, 225, 3 lakh 60, 2 lakh, 3 lakh 75. When you add up, you will get the value as 14 lakh 10,000 divided by the number of years, so 5 years. When you divided, our average profit should have been 2,82,000. From our average profit, we have less tax. In this case, the tax is 40%. So less 40%. The 40% of 2,82,000 will be 1,12,800. You will subtract this and we will get profit after tax. So profit after tax will be 1,69,200. Now from this value you need to deduct, okay, from this value we need to deduct any transfer or any preference dividend. Now there is no transfer given in the question, but then there is preference dividend. So I'll write here preference dividend. The value of preference share in the question is 1 lakh and the rate of dividend which is given is 8%. So 1 lakh into 8% is 8,000. We subtract this and I get 1,61,200 as my profit available to the equity shareholder. So this is nothing but profit available to equity shareholder. Now once I get my profit available to the equity shareholder, I can go ahead and find my expected rate of return. ERR is profit available upon equity share capital into 100. So the profit available is 1,61,200. Equity share given in the question, if you look carefully, is 5 lakhs into 100. So our expected rate of return is 32.24%. Last value of share as per yield method equals to ERR upon NRR into paid up value. ERR is 32.24. NRR, in the question, NRR is given as, if you look carefully, it's given as 12.5%. Into the paid up value, equity share ka paid up value is 10. So when you multiply, divide, you get a final answer as rupees 25.79 rupees. That's the value of share as per share as per yield method, also known as earning capacity method. Okay, so with that, video based on finding value of shares as per yield method comes to an end. With this, we were able to solve two different sums under the same method. I hope everyone have understood this. With that, we will be ending this video here. Thank you.